Guys, so today we'll be hosting Carley Garner. Carley Garner is a commodity futures and options expert. She has her own brokerage firm called DeCarley Trading. She's based in Las Vegas, Nevada. This is our seventh time on our trading lounge. So we're gonna discuss a live trading setups for her most recent trades, all matters commodity trading. So watch this webinar to learn how to trade commodities like a pro. Cheers, guys. Hello. Hi, Carly.
Hi.
Hi, Carly. I'm so sorry. I don't know what's
That's
up with
okay.
it.
No, it happens. No worries. Thank you.
How are you doing? It's been so long
I'm
since
doing
we
just fine.
spoke.
Yeah, it's been a while. Things are
Yeah,
good. How about you?
I'm doing well as well. I've missed you quite a bit.
Oh, that's sweet. Thank
Yeah.
you.
How is Frankie and everybody?
Oh, she's sleeping. She's kind of lazy. She sleeps while I
Uh,
work and then she's ready to play when I'm done. So keeps me busy.
okay. Yeah, she's your baby.
Yes, she is.
Yeah, and a darling too. I normally see her accompanying you everywhere you go.
Yeah, she's attached. She doesn't like to be left alone, so she comes with me.
Hmm. Okay. So I think for today, because you're no stranger to our trading lounge. I
Hmm.
think this is the seventh time that we're hosting you.
It
What we
is.
can do is we can go through your most recent trades, and then you
Okay.
can pass through your trading approach. And then from
Mhm.
there, I think I already have your bio on previous webinars, but I will do a separate intro for that. So
Okay.
we will just go with the flow. We'll just take 40 minutes. I think we're already 8 minutes in because of the link issues, but we're here to
Hmm.
learn from you, Carly. So just take it away. Yeah, let me
Okay.
give you
Sounds good.
access to share screen so that
Okay.
you can be able to actually share from your side. Yeah, you're good to go now.
Okay, I'm gonna jump over to the computer and some
Mm-hmm.
stuff here.
All right. And then also thank you guys for joining in, Elizabeth and Maureen. The rest will join us as we go. Feel free to type in your questions on the chat section, and then we're gonna ask Carly during the webinar.
Okay, hopefully you can see my screen.
Yeah, we can.
Okay, so I'm gonna start with just a couple of charts, and then we'll go over some trades that we've been kind of recommending to our client. Not kind of, we have been recommending to our clients. We're gonna start
Okay.
with gold. I'm sure a lot of people are following gold pretty closely.
Mm-hmm. Yeah, especially after
Um,
the tariff situation and all.
Yeah, it's been a crazy year for gold, and this is a really unusual time for gold. Gold is an interesting market. It's a kind of market that it can. I've seen it, and I have. I mean, I know gold can go sideways for years, and then when it finally makes a move, it makes it all at once. It's a period of time that gold makes its move, and to be 100% honest, I think going forward, we probably see a lost decade or so of gold, and where I'm not just you know making that up. I've lived it before. I'm pretty old. I've been through some of these cycles before. We saw literally the exact same kind of setup in gold, three waves. Now this wave is a lot bigger and a lot steeper, but that's probably just kind of the result of global stimulus. A lot of things that came along after COVID. There was a lot of money thrown into the system. And I think this is probably what allowed gold to go this far, this fast, and in such a parabolic manner. But that doesn't mean that these prices are permanent, and it doesn't mean they will stick.
Mhm.
Um, the thing that's really jumping out at me is you can see the RS. This is a monthly chart, by the way. RSI. has poked above 70 multiple times, but it never holds above 70. It's generally, might hang in there for a month or two, but eventually gravity takes hold and we pull back. So believe it or not, I think we could possibly see gold retrace this entire rally. That'd put us back at 2170, or maybe even go a little bit lower and test this longer term trend line around 2000. I know that's kind of outside of the realm of most people's wildest guess, but I've seen these markets do this before. In 2011, when we had a similar setup, gold corrected 45% and traded sideways for about a decade before it recovered. So let me show you what we're doing with our clients now. All right. Okay, so this is a trade that we actually recommended yesterday. Now, just to be transparent, we generally are option traders. A lot of the trades that we put out and we recommend are intended to be held for weeks or months, not necessarily days. But in a market as volatile as gold, in reality, we've seen the market move years worth of price changes in weeks. And so it's just that kind of environment. So we've been in and out of gold multiple times. The idea is we're selling into rallies. Yesterday, obviously, the last couple of days has been a nice rally in gold. We're up against a trend line on a daily chart. So we decided to employ this. Let me see if I can. I was hoping I had the daily chart out, but I don't. So we'll go to this. And you can see this is a daily chart of gold. So before I was showing you the monthly chart, this is the daily chart. And you can see that we've made some pretty dramatic highs, but they're all trending in the same direction, lower highs. And so far we've made higher lows. So this is still a bull market, still an uptrend. I think it's going to end, but then again, I can't see the future just like anybody else can. But what we do is we try to put trades together that are intended to make money if we're right and not lose very much or break even if we're wrong. And so this is what we've done in this particular case. Seasonality in gold is generally bearish throughout the summer. Normally it peaks in like April or May. We haven't really, I guess you could argue this might be the peak. If gold sells off from here and continues lower, then we could easily say, yeah, that worked out as planned. But I can tell you, anyone that's involved in this market, in this whipsaw, probably feels differently just because it's been a painful trade, regardless of which side of the market you're on. So we were lucky enough to kind of catch a couple of these down moves. We started, just to be 100% honest, we started playing the downside here. And obviously we took a lot of heat in a short amount of time, but it ended up working out for us and we got out. I don't remember the exact math, but it was small loss and we were happy with that. And then we kind of reloaded. And ideally, we'd like to be selling rallies indefinitely until the market proves that it can, do something that we aren't expecting. Often you see gold really plunge in the late summer months. So around July or August, there's often a really big downdraft. And so we're hoping to catch that. So anyway, if you're unfamiliar with options are eroding assets. So if you've ever bought options, it's a really difficult game. Hard to make money buying options. So what we try to do is we sell options around our long options to pay for them. And so what we've done here is we want to be long a gold put. A put makes money if gold goes down. Basically, we're buying the option or the ability to go short a futures contract at 31.50. But if we were going to buy that, in fact, I don't know if you can see this up here, but that particular option, the 31.50, would cost $35 in gold or $3,500. So we're not about to spend $3,500 on an option that may or may not work, and it's going to slowly erode in value if it doesn't work. So we took the opportunity to sell a 3,000 put and also sell a 4,000 call. So we're collecting money on these. We're using the market's money to buy this 31.50 put, and it gets us in the game. believe it or not, this doesn't look like a very big gap, but this put spread would pay out as much as 15,000, 3150 to 3,000 on one gold futures is a $15,000 move. And because we got into this trade for basically free, I'm going to round it to free. I think we ended up paying a few dollars, $50, $80, but we'll just call it free plus transaction costs. You also have to margin the trade. The margin's about $6,000. So you can't put this in an account with zero money, even though it's a free trade, because you have to be able to pony up for the losses if we're wrong and the market rallies towards 4,000 or above. So the way that the payout works on this is you make money if you hold expiration, and I would probably never hold expiration, but if you did, and gold was below 3,000, this spread, long the 3150, short the 3,000, would make $15,000. And this option would expire worthless. If we're wrong and gold breaks out here and starts making new highs, we can be wrong until it gets to 4,000. So we can be wrong by roughly $600 in gold. And I know in today's world, $600 doesn't seem like maybe that much, but it is. I mean, I've had years as a broker where gold doesn't move $600 in 2 or 3, 4 years, let alone a handful of weeks. So on paper, this is a pretty high probability trade, but there is no guarantees ever that it's going to work out, obviously. But the odds are pretty good. And as long as gold's below 4,000, but it's above 3150, all of these expire worthless, and it's no harm, no foul. We move on, we broke even though we were wrong. So that's kind of the idea of this type of trade. Clients of ours receive an email like this that displays exactly what the trade is, how much we're paying, what the margin is, what the risk is, which it's unlimited in this situation. And people get scared when we start using words like unlimited risk. And I don't blame them, but the reality is if you're trading futures or CFDs or anything like that, that's basically leveraged and based on commodity prices, the risk is theoretically unlimited anyway. Even if you put a stop loss order in on your futures or your CFD, it's not guaranteed. There might be a lot of slippage. So your risk is technically unlimited, whether you're selling options or buying or selling futures or buying or selling CFDs. We don't look at it that way, but that's the reality. I'll show you a different way to play this.
Are there trades that you trade without applying options?
Uh-huh.
Are there trades that you normally execute without applying options?
Like outright futures or like buying or selling an outright future? We generally, the thing is, trading is a personality game. And my personality is not great at handling outright futures trades. It stresses me out a little bit. So I personally prefer options. So I recommend to my clients options. However, we have clients that don't like options. They don't like the math. They don't like the hassle. They prefer things to be simple. So we had a few clients that wanted to do this trade, but using futures. So instead of the delta on this trade is basically 20%. So what that means is if somebody wants to trade gold in this type of manner, but with futures, not options, what we recommended to them was just simply sell 1 or 2 micro gold futures. I'm not familiar with CFDs, so I don't know what the pricing would be. But if you did something like that, I would suggest probably starting with 1 micro gold future. 1 micro future is 10 ounces of gold. And with that type of small position on a futures, the math is very simple. You make if it broke out and rallied up, I would probably suggest somewhere around, let's say 3,600, which would mean a new high. You got to give room for markets to run stops and those get the sucker in the last buyers. So somewhere around 3,600, I would suggest selling another one, and that would get you it would get you a trade with a similar risk to what this option trade was. So yes, a lot of our clients don't want to do future or don't want to do options. They do futures instead. We generally recommend the micro contracts, or again, I don't know CFD sizing, but you want to keep the sizing small. In fact, you want to keep it so small that you almost feel like it's boring, because then if you're in the wrong place at the wrong time, you're going to have the mental capacity to make a good decision as opposed to panicking and doing something you shouldn't be doing, because we're all human. we tend to panic if our trade is too big and we're underwater and we don't like it and we're uncomfortable, we do dumb things. That's just what we do.
Okay.
All right. So if you don't want to play gold, you can, a similar idea is in the currency markets, gold, there's a little more going on than in gold other than just the weak US dollar. There's lots of things going on. However, if the US dollar bottoms, which I think we're getting pretty close to a US dollar bottom, if that occurs, gold is going to go down, all else being equal. But if you're not wanting to play gold because of the additional risks that come with, just all the chaos that comes with precious metals, another way to play it is the currency markets. What we did was we just bought euro puts. So we bought out of the money euro puts. They're relatively cheap. If the euro goes down, the dollar is going to go up and vice versa. So this either makes money or it doesn't. There's no margin. It's limited risk. You could do this with a micro euro future or a mini euro future or against, in a Forex account in a very small way. Again, I would not bet the farm. I'm not saying, risk your whole account, go and short the euro, but I think it's worth a shot. Got a chart here. Let me see. I think it's this one. Here we go. This gives you an idea of where the euro is relative to gold. So the gold, this is a monthly chart, by the way. So it's 20 years of price data, roughly. The gold market is obviously yellow or gold. The blue is the euro. And what I'm trying to point out with this is the gold market is vastly overvalued compared to the euro. And the only point I'm trying to make is there was a time during my career in 2006, 2007, where nobody could get enough euro. Kind of like what we're seeing in gold. You can see how this move is parabolic. Everyone wanted to be long the euro. Nobody trusted the dollar or any other currency. It was the euro or bust. Celebrities around the globe, especially in the US, were demanding, like movie stars, athletes were demanding to be paid in euro because their opinion was the US dollar was just fiery garbage and they didn't want their money to be in US dollars. Instead, they decided they wanted gold. I'm sorry, they wanted the euro. Now we can see how that worked out for them. The euro, believe it or not, was at 160, 170 back then. And obviously we know we're at like $1.14, $1.05 now. So the euro, when everybody wanted to be long the euro and nobody wanted dollars, nobody wanted any other currency, is precisely the moment that the euro peaked out. And 20 years later, we have not been anywhere close to those valuations in the euro.
Mm-hmm.
When I hear people talk about gold or Bitcoin, some of these alternative assets to the US dollar, I am reminded of what I saw back then. Everybody wants to be long gold and Bitcoin because they don't trust the US dollar. They don't trust the US government. That's the narrative anyway. Same narrative I heard back here. And this was the result. So again, I don't have a crystal ball. I don't know what's going to happen, but I assume it's going to be the same result. The US is not perfect. Obviously, we have a lot of debt. We have some financial issues, but the reality is most countries around the globe also have those same issues and maybe even a bigger magnitude. US dollar, love it or it's the most stable and most liquid currency in the world. So at some point, everybody that's flocking into gold or alternatives is going to look at this and say, well, I'm missing out. If I have my money in US dollars, that means I'm probably buying US treasuries, or even if it's sitting in a bank, it's earning US interest rates. Gold doesn't earn interest. Gold just sits there, earns no cash flow. US dollars earn cash flow. And in fact, US dollars are earning more cash flow now than we have in 20 years because interest rates are high. So again, I think we're going to get a repeat of this, but with the gold market.
So is that based on the fact that markets are cyclical? And then maybe you can touch a little bit on seasonality, given that you trade futures as well.
Mm-hmm. Sure. So seasonality is the idea that annually, a lot of markets, in fact, just about every market has some sort of seasonal pattern where prices tend to be high or low for certain reasons. For example, I just mentioned gold. Gold prices tend to peak out in April. They usually bottom out in August or so after a pretty rough summer. And then they usually rally going into the end of the year. There's lots of reasons for this. Part of it is currency market repatriation of corporations. Part of it is Indian wedding season. I mean, there's lots of things. And to be honest, a lot of seasonality cycles occur every year. And I couldn't even tell you why. It just happens for whatever reason. So in the grains or things like that, it's a little easier to explain why seasonals work. Currencies and stocks and those sorts of things, it's a little more difficult, but a lot of it has to do with cash inflows from businesses or investors in the US. Not most, but roughly half the country in the US has retirement accounts where every month they put money into these retirement accounts. And then there's usually big lump sums that come in like at the end of the year and beginning of the year, which is why in the US you see the stock market rally in December and January almost always, because people are putting money in regardless of fundamentals or anything. They're just really not trying to time anything. They have the money and they put it in. So there's all types of reasons for these cycles, but there's annual cycles that occur. And what we're looking at here is a 20-year chart. So this is a kind of a bigger, not an annual cycle, but markets also go in cycles of I'll just kind of probably generally decades where they go through different phases. And so a big part of speculating is determining whether or not you are in, what phase you're in and what cycle you're in. And are you in the ninth inning, which is where I think we are here. And if I'm right about gold topping out, then the euro probably eventually makes its way higher. Now, for now, like in the short run, if we're talking the next handful of weeks, I think euro probably goes lower, dollar probably goes higher. Well, let's not say weeks, let's say months in that time frame. But yeah, cycles are very, very important. While we're talking about cycles, I'm going to pull this chart up real quick. This is a chart that shows you the relationship between treasury bonds. This is a 30-year bond, almost 6% interest a year, versus gold. And what normally happens and what should happen, it has not happened this cycle because of all kinds of things. There's a lot of political turmoil. There was a lot of stimulus that came into the system after 2020. A lot of weird things have thrown this market off of its normal cycle. What should happen is as interest rates get higher, it should work against gold prices. The gold is in green and red. The 30-year bond or interest rates are in blue. So, oops, I'm so sorry. The blue is gold. So that's gold. And the bonds are red and green. As treasuries or bonds get cheaper, that means interest rates are higher. And it should prevent gold from going higher, because if you're somebody that wants to put money in a safe asset, you can basically choose between government or sovereign debt. In this case, we're looking at US treasuries or gold. And if you look at gold, there's zero interest being paid, zero income. If you look at treasuries, there's 6% being paid. So just from a mathematical standpoint, it makes so much more sense to buy treasuries because you have a cushion. The market right here, obviously, for 3 years, we've traded sideways. It's gone nowhere. But anybody that's long these is making 6% a year, even without any type of price appreciation. In gold, people are making more money than that because gold's rallying. But what happens if gold comes down? If gold comes down, they're losing a lot of money very quickly with no cushion, no income or cash flow to cushion that. So mathematically, it really makes zero sense for people to be buying gold instead of treasuries. But ironically, that's what everybody's doing. If you look at the numbers, everybody's clamoring into gold and nobody wants to own treasuries. It's been my experience that when everybody's thinking the exact same thing, they're usually wrong. That's unfortunately, markets are mean, and that's just how it works. I don't know. This has taken a lot longer than I thought it would take, to be fair. But I think it's just a matter of time for these things to come back in line. Treasuries would rally, interest rates go lower and gold's got to come back down to some sort of realistic price range.
Mhm. Okay, so at this point, I'm gonna ask the attendees to
Okay,
the Q&A option is
perfect.
open. You can type in
Okay,
your question in the chat section.
perfect.
Maybe Carly, you can also take us through maybe an agricultural commodity that
Okay.
maybe you've been looking at recently.
Yeah, so the one that I really am interested in is wheat. Um, you may have remembered wheat was uh, really exciting when Russia invaded Ukraine because Ukraine and Russia are both big wheat producers. And there was a fear that we would basically, the world would be short on wheat. And as it turns out, we got wheat really wasn't impacted that much. Supply was just fine. So we rallied in wheat all the way up to $14. And we have since spent the last 3 years dribbling down to $5. And it seems hard to believe, but it's not. In my opinion, it's harder to believe that we got up here than we came back down here. You can see we've seen this before. Let me stretch this out. In 2006, 2007, we had a similar rally where wheat got up to 13-ish dollars and then it came all the way back. I think when I look at this chart, I see this big retracement here, consolidation, and then we had some big rallies. I think this is what we're going to see going forward. I'm looking for some pretty big rallies in wheat. This is a 20-year chart, and you can see it's only tested this line a couple of times, but this line has been pretty solid. And you have to be patient in wheat. You could see here in 2004 and 2005, it took a year of nothing, just a whole bunch of nothing going on before it finally took off. Um, this time around, we've been trading down here for about a year. And, is it going to happen in a week or 6, 8 months? I don't know. But I think being long wheat is a good place to be. The great thing about wheat is you can have, there's mini contracts. Actually, there are micro contracts now. They just added them. So you can be long futures in a very, very small manner and just wait. What we've decided to do is we are long futures on the full size contract, but we bought a put option just in case. I can't remember the exact strike. I want to say a $5 put. I believe that's right. So we're long September futures with a $5 put as insurance, just in that's going to be the case. We've tested this trend line basically once every 10 years and it's held. So wheat is a good one to look for. I think a rally might be on the horizon.
All right. I'm checking the chat section. I don't see any questions, but maybe
Okay.
guys, you can find more analysis for Carly through her channels. And then she also does like market analysis for Jim Cramer's show. Maybe Carly, you can mention where people can go to actually get access to your analysis.
Sure.
And
So you can follow me on X, previously Twitter. My handle is at Carley Garner. We do post a lot of things to social media. You can find me on LinkedIn, just search for Carley Garner, or even Facebook. Another thing you could do is if you go to our website, it's dcarleytrading.com. I'll pull it up here. You can sign up for a free trial of our newsletters so you can kind of get an idea of what we're doing. This is our webpage. If you look to the right-hand side, there's a button for a free newsletter trial. And if you just fill out this information, we'll send you our newsletters. The newsletters will include market commentary and analysis, but also they will include trading ideas.
yeah, and then maybe you can also touch on what they should look out for because you're a broker and you've been in the business for some time. We've seen the era of brokerage firms come and go. What has
Mm.
kept you consistent, especially in the US markets?
Well, it's unfortunately, like I wish I could say read a lot of books, watch a lot of webinars, and those things are all very helpful. But the only real way to learn risk management is to experience it. And sometimes you have to learn the hard way. I wish that wasn't true, but as humans, we don't fully appreciate and understand the risks until we're on the wrong side of a horrific market move. And then we realize, what's the best way to go about it. Over the years, I've learned less is always more. don't worry about leaving money on the sidelines or getting out too early or don't worry about any of that stuff. Worry about how much you can lose. If you're focused on how much you can lose and hedging your risk and managing your risk, you're probably going to stay in the game long enough for your strategy to work. Regardless of what your strategy or your analysis approach is, it's going to work in some market conditions, and in others, it's not going to work at all. That's just the reality. There's no approach to trading that works all of the time. There's only approaches that work more than they don't. And so whatever that is that you find that you are comfortable with and you feel like you have an edge, the goal is make sure you're in the game. You have chips on the table. You have to be in it to win it. And the only way to do that is to manage your risk. If you're taking on too big a risks or you're uncomfortable with your risks, you'll make bad decisions or run out of money before the good times come.
All right. And then also because I know you're mostly a technical analyst when it comes to your analysis. I can see some of the indicators that you use here. I can see I think I saw an EMA 200 day.
Mm-hmm.
Maybe you can touch on what kind of indicators that you use for your
Sure.
trading. And then also, I think when guys actually heard about commodities trading, they would expect that you also do trade some energies. I don't know if you've been trading oil recently. Maybe we can touch a little bit on that as well.
Sure. So what we really try to keep it very, very simple. I use RSI as my oscillator. Now, a lot of people ask a couple questions, or they ask, why RSI? Why not something else? Reality is oscillators are going to give you basically the same information. They take data, price data, and they formulate it either are quick to trigger and some are slower to trigger. RSI for me, for whatever reason, it's worked for my pace and my personality. Tells me when markets are overbought and oversold. Now it's just like any type of oscillator, it's an art, not a science when you're trying to use it to anticipate moves. But what I like to look at is divergence. If you see, for example, the RSI here spiked up, and then as the market made a new high, the RSI made a lower high. When you see divergence, and again, divergence is when your oscillator is not making a new high, but the market is. That's kind of a sign of dysfunction. Now, doesn't mean sell the farm, go short, and set it and forget it, because you can see that dysfunction. I mean, although it did work pretty quickly here, market came back and consolidated, and you can see it's a process. It worked. It showed us this is not a healthy market. This is not a healthy rally. Something's not right. But it took a long time for that to materialize. So you have to just kind of decide what your time frame is and pick an oscillator that works with that time frame. If your time frame is minutes or hours, maybe that's not the right one. But I also use this is orange line is a 200. This is a weekly chart, but this is a 200 period moving average. So because it's a weekly chart, it's a 200 week moving average. Very, very long-term stuff, very reliable. But if you're using weekly bars to determine your trade signals, you're probably only going to get one or two signals a year, so keep that in mind. I don't necessarily use the weekly chart for signals, but I use it for my big picture analysis. So I look and see what's the big picture, because it's easy to get tied up in the day-to-day fluctuation. In the big picture, you can see, just to kind of reiterate my point, this is a weekly chart. The last 3 weeks, the S&P has really gone nowhere. It doesn't feel like that because we've had some big up days and big down days, but it's really gone nowhere. So looking at a weekly chart kind of tells me that. But the most important thing I look at is just trend lines. It's nothing fancy. I'm not trying to reinvent the wheel. I just draw basic lines. And the crazy thing is they work more than they don't. So that's how I do. We definitely follow crude oil pretty closely. This is a monthly chart of crude oil. So again, I wouldn't use this to trigger signals, but it's worth noting that crude oil is kind of toying with $65. We recently broke below 65. This red line is 65. Anytime crude oil gets below 65, it's kind of like a death sentence. You can see it's only done it a few times in this is 20 years. Time has been really nasty. We dropped from 60 to 30 here. From here, we dropped from 60 to 29. I think it was 27 maybe on the lows. This time around, we dropped below 65 and it eventually went to negative territory. So we're right on the cusp here. If oil doesn't get above 65, let's say by next week, I'm worried we get something really deep on the downside in oil. My first target's about 48. We'll have to see what it does with that, but you can see on the previous occasions under 65, we haven't stopped at 48. I'll put this green line where I think we might go on this first move, but you can see even if 48 holds on the first time down, it's probably not going to hold indefinitely. Below 65 is a bad place for oil to be. I'll just throw this in one last thing. This is natural gas. This is a daily chart. We're long natural gas with options. I'm thinking natural gas is going up to 410, 420. This is obviously US natural gas. That's kind of a tough market. So if you've never traded natural gas before, keep it very, very small there. They don't call it the widowmaker for nothing.
Mm-hmm. All right. Thank you so much, Carley. At this point, I would like to give a shout out to Carley Garner's brokerage firm. If you're based in the US and the environs, you can actually trade using DeCarley Trading. And then also shout out our sponsor for our webinar for today. We have a new brokerage firm that's female-led as well, just as DeCarley. With a friend of mine from Cyprus, and they're launching in Africa. So her farm is called TB Globe. I'm gonna link them to this show notes. They have offices in South Africa. They have a license there. They have a CISEC license. They're looking to get CMA, so they will officially be launching in Nairobi as well. So we'd like to just mention them during this particular time. So for Carley, what would be like your last trading tip for us in 2025? We've seen a lot of things happen this year. What would be like your takeaway for us?
Well, we've seen this year's volatility has been really pretty wild, obviously. In a lot of these markets, we're moving years worth of price changes in days or less. So what I would say is don't ever feel like you have to have a trade on. Don't ever feel like you're missing out if you're not in, because I can promise you it's a lot more comfortable missing a trade than being in a trade that you don't want to be in. So just be very patient, stick to your strategy. Don't chase markets unless that's your strategy. Maybe you're a breakout trader. I don't know, but just keep it simple. Stick to your rules. Don't try to swing for the fence, because those people that are trying to swing for the fence in this environment are most likely going to come out as bag holders. You don't want to do that.
All right. So also, I want to give a shout out to our attendees for today. So we see you, we value you, and we would hope that you guys will join us next time. So I can see Joseph, Tim, Liz. There's one called HP. I think that's the license the laptop. Mary Wanjiko, Maureen, and Victoria. So thank you all for streaming in tonight. Kali, we're gonna let you go. For us, it's a good night from Nairobi, and I'm hoping to meet you soon. Whether that would be in Africa or in Vegas, we'll plan. We'll see something. We can work out something. So
Sounds good. Thank
yeah.
you. Sounds fun.
Yeah, and thank you for your time. Of course, we'd
Of
love
course.
to host you again in the future. So I'm gonna share this recording with you once it's up tomorrow.
Okay.
Yeah,
Sounds good. I appreciate it. Thank you.
yeah. Guys are actually happy to meet you. So they're saying thank you for the wonderful presentation. They hope to see you again in the future as well.
You're very welcome.
All right, cheers. Bye. Bye, everybody.